We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Danielle DiMartino Booth, CEO and Chief Strategist for QI Research, former Fed insider, and also the author of the book Fed Up. Danielle, how are you today?
I'm doing great. How are you? It's good to be here again.
Absolutely excellent to always speak with you, Danielle. You know, you bring us such an interesting and insightful perspective. So I wanted to start by asking you what you think is the most important things to keep watching for the economy currently.
So I think what we need to be most mindful of at this point, because we've seen such deep and large, unprecedentedly large revisions to private payrolls, that's what we need to be paying the closest attention to going into 2025 is what is the private sector going to do or not do in the coming year, because we know that private sector, even with some decent revisions to October payrolls, we know that the private sector still shed jobs in November, and that looks like it was the continuation of a trend that began earlier in 2024. So that needs to stop.
Mm-hmm. Well, I know that you and I have spoken about this unemployment issue before, and I want to get into that. But to kind of contrast what we're focused on for the economy, what do you think the Fed is most focused on right now? Is that the same thing?
I actually do think that the Fed is focused on the same exact thing right now. Shelter inflation is about 40% of the input to CPI. So even if we get a few hot prints going forward, if you just factor in work that the Cleveland Fed has done a very good job of, and that's to try and modernize, make real-time shelter inflation metrics more reliable. If you just factor in the work that they've done, we know that shelter inflation is going to drift down from 5% year over year to 2% year over year in 2025. So that will act as an anchor on the Fed's inflation mandate, meaning their focus should be exactly what mine is right now. And that is, what is the private sector going to do? Because it's not just people like me. In fact, it's typical PhD and academic types bureaucrats. They're paying very close attention to these revisions that we're seeing, and they're making presentations at Fed meetings about them.
Mm-hmm. So, going back to that question, Danielle, do you see unemployment numbers trending in any bit of a different direction over the past year? You and I have spoken about this at length many times here. Has the pace accelerated or abated somewhat?
Well, again, to be a broken record, with the revisions in hand, we know that the pace of layoffs has accelerated going into the end of 2025. We've gone from a 3.4% unemployment rate to 4.246, which is about 7,000 jobs shy of being 4.3%. So we're effectively at a 4.3% unemployment rate, and we've never seen a move of that magnitude off of the low without already being in recession.
Mm-hmm. I know in his last press conference, Powell really didn't mince his words when he asked if he would resign because of the outcome of the election. So do you think he has an axe to grind or some kind of point to prove in any way until the end of his term versus Trump?
I don't think that Jay Powell has an axe to grind, especially because President-elect Trump has already come out and said he's not planning on firing him. Mm-hmm. And in his most recent interview, Jay Powell said that he was getting along well and had every intention and plan of getting along well with the incoming administration. So I think that he and our incoming Treasury Secretary, Scott Bessent, Jay Powell and Scott Bessent are very rational, calm individuals, and I can't foresee any reason that they wouldn't have a very productive and functional working relationship going forward. That's good for the country.
Mm-hmm. Danielle, are you still expecting a recession despite the market's reaction to the election, or has the Fed achieved the soft landing that they were after?
So there's nothing to lead me to believe, again, given these revisions, that we're not already in recession. Mm-hmm. The Bureau of Labor Statistics, the Bureau of Economic Analysis, which produces the GDP figures, They came out after private non-farm payrolls were revised down by 1.2 million jobs. They came out and said that rather than what was originally reported for personal income, just based on what they know of 1.2 million fewer jobs being created in the year ended June 30, 2024, that based purely on that, they know that personal income in the United States in the third quarter was going to be revised down by $91 billion to $65 billion. So I didn't get my math wrong there. So the downward revision to third quarter 2024 personal income, the size of the revision of 91 billion is larger than what you're left with, which is 65 billion. That's a huge, huge number. And it helps explain the mystery, if you will. Why do these credit card delinquencies keep rising? Why do these auto loan delinquencies continue to rise? Why are we seeing FHA mortgage delinquencies already higher than they were at the peak of the last housing bust? We're starting to figure out why, because revisions are telling us history through a rearview mirror that Americans have a lot less income than we thought they did. So there's no mystery to these delinquencies. Now we're starting to just finally see it coming through to the data.
Mm-hmm. In some ways, do you think that we sorely need a recession, Danielle?
I don't think we sorely need a recession. No economy sorely needs any recession, but I do think that when S&P announces that bankruptcies are running at a 14-year high, that we're certainly getting rid of the bad actors in the economy, the bad business models, the ineffectual companies, and that always provides for long-term prosperity for a country. You get rid of the bad players, you bring in the new ones, you make room for new entrants to create jobs. And that's certainly, that's the silver lining for any recession, is that you end up with a faster pace of longer term growth.
Mm-hmm. So is this possibly, let's say, the best way to kind of go about reallocating that capital to better players, as you put it, into the space, is to, step by step kind of not dramatically have a big crash or a big spike in unemployment and gradually make that shift to reallocate that capital?
Well, that's certainly been what we've seen in 2024 with bankruptcies at a 14-year high. We haven't seen the world end, and yet we know that this is the product of higher for longer. Mm-hmm. And this was one of the reasons that we're going to look back in history and say, maybe the Fed should have started cutting rates sooner, but what we got out of the Fed leaving rates higher for longer than anybody since Paul Volcker was in office was a rational reallocation of capital to the stronger players in the economy. And that's a positive statement I've just made.
Mm-hmm. Absolutely. Danielle, I've heard you speak before about the confidence bubble of central bankers. What does this apply to, and do you think it is about to change or get burst anytime soon?
So I think that what's happened that is different than in 2000 and in 2007 and 2008, when Bernanke introduced the zero bound for interest rate policy and quantitative easing at the same time, right? Every bailout by the central bank has had to be bigger and bigger. I think the difference between 2001 and 2007, 2008 is demographics. And whereas you had baby boomers at the time see their portfolios after a stock market correction and after home prices had fallen, you saw baby boomers make the decision that they were able to stay in the workforce for another 10 years or so and make the money back. We're not there right now. Mm-hmm. We're not at a point where baby boomers, even though people over the age of 70 own 40% of US stocks, people over the age of 70 don't have the physical flexibility to go back into the workforce for another 10 years into their 80s. That's just not realistic. So now you come to the point where you test the confidence bubble in central bankers. If the central bank can't convince the people who are in their 70s to go back into the workforce, then they're going to be starting to liquidate their stock portfolio as the amount of interest income they're earning decreases with every Fed rate cut. Mm-hmm. And I think that that's a lot of the reason behind the sell side being as emphatic as it is that the Fed's going to engineer a soft landing. I think a lot of people on the sell side are trying to protect that interest income. So you don't end up pushing the envelope and forcing baby boomers with continued rate cuts into 2025 to continue selling off their stock market portfolios, because that doesn't work for people on the sell side. For people on the sell side, you have to always be long the stock market.
Mm-hmm. So can you give us a sense of how that ends up shifting the markets? Like you said that they always have to be long the stock market. Are they just liquidating what they have and putting it into something else to replace the income that they once had?
Well, certainly when you were getting 5.5% on a money market fund and that becomes 4.5%, something's going to have to offset that income that is foregone, that income that is lost. And whether that is, getting out at the top of the stock market, great for them. If that's not the case, however, then you could start to talk about the second home market and whether or not the baby boomers are going to either be bunking up with their children and we're going to see a continued increase in multi-general household formation, or whether they're going to be downsizing to a smaller house and starting to sell these McMansions that we used to call them, where they've got a bulk of their net worth stored up.
Mm-hmm. Danielle, something I've been trying to ask several guests about is the dollar strength since the election. If Trump in reality needs a weaker dollar to achieve the things he's set out to do, like be more competitive on exports and try to, let's say, retain the market share for the dollar as the reserve currency, how would the Fed and or Treasury go about achieving this goal of having a lower dollar?
Well, that's a pretty difficult thing to do when your new Treasury Secretary has already advocated for a strong dollar. And it's also not something that necessarily can be achieved in a vacuum or in isolation. You have to talk about the weak link in the global economy of Europe having the ability to offset a weaker dollar by having a stronger euro. I think the last thing that China wants also is to have a stronger currency, because they're trying to support their own recession by increasing their manufacturing output and increasing their own exports. So you have to be mindful of whether or not the goal is to have a weaker dollar to support the U.S. industrial sector, and whether or not that's achievable, because that's not something that you can achieve on your own. That is not a unilateral decision that's made. That's something that is made in concert with other countries being able to afford themselves stronger currencies.
Mm-hmm. But in, let's say, just taking that example and saying that was our only goal, would we go back to QE to basically devalue the current, let's say, market value of the dollars in circulation, or how do you think they would go about that?
I mean, in theory, but right now Wall Street is saying that we're not going to even get rate cuts. And the way the Federal Reserve operates when it comes to the idea of quantitative easing is with prerequisites. And prerequisite number one to getting to the front door of relaunching quantitative easing is you stop quantitative tightening. They haven't even done that yet. Mm-hmm. But B, you get to the zero bound. And right now there's a furious debate about whether or not there's even going to be a rate cut in the month of January. Mm-hmm. But so if you can't even get there, then you can't even get to where you're discussing quantitative easing. So these are not overnight solutions. When the so-called dot plot, when the summary of economic projections that the Federal Reserve produces indicates that they see the federal funds rate ending somewhere around 2.93%. So again, they have to get to the zero bound, which means they have to completely revamp their own expectations in order to begin to have a discussion of forcing the dollar to be weaker. I don't think that's who Jay Powell is. And he is, according to Trump, going to finish out his term, which ends in May of 2026, mm-hmm. when there's already going to be politicians on the campaign trail for the midterm elections.
Right.
There's a lot of ifs
mm-hmm.
in what you asked, is what I'm trying to say. And you have to get past all the ifs to get to the when.
Absolutely. As you said before we started recording today, we're in a kind of wait and see holding pattern at this point. A lot can happen between now and mid-January, right? And of course, like you said, we're going to have to wait and see how that ends up shaking out. I want to get your sense on inflation right now. Is this still the problem that it once was? And, I recently spoke with a guest that said that the Fed has now basically accepted a new floor for inflation being 2% and not the new average. Would you agree with that?
Oh, I think whoever your former guest was is absolutely correct. I think average inflation targeting has been thrown out the window. And I think the Fed is committed to that 2% target and getting there. I don't think they're going to struggle as much, however, because again, as we were talking earlier, from what we know from the Cleveland Fed, the shelter inflation, which is 40% of the input to the CPI, is going to drift down from 5% to 2% year over year by the end of 2025. We're certainly seeing that. We're seeing that in data from large publicly traded apartment REITs. And they're seeing the rents that they're able to charge have now fallen below the 2015 to 2019 averages. So the writing's on the wall. Mm-hmm. And that's coming from the marketplace, not from an economist model. But even so, even the economist models are taking into account the fact that shelter CPI is going to drift from 2 to 5%. It took a good 12 months from when the tariffs were first announced in Trump's first term before we saw any goods inflation. So even if we're going to get kind of this headwind of goods inflation that comes out of any new tariffs, it's really not going to be manifest in the data, at least for another year.
Right. You kind of bumped into the next subject that I wanted to talk to you about was the confidence in the housing market right now. What triggers or indicators are there of things changing? You mentioned the housing REITs and rents falling. So is that another sign of things to come?
Well, it certainly is when you combine with that the fact that we've got more houses on the market, combined new home inventory, existing home inventory than we did in 2019. Even on just the existing side alone, inventories are only down about 16% year over year compared to where they were, 16% over where they were in 2019. But you throw in the fact that you've got more spec homes that are completed and on the market than any year since 2009. Builders are very aggressively buying down the mortgage rates for the home buyers to come in and buy these new homes. So we're seeing downside pressure across the board. We're also seeing it come out of the investor community and starting to hear rumblings. I joked that an overseas investor was dumping entire portfolios and entire subdivisions of U.S. homes that they had bought as an investment. I said, well, I jokingly sent a tweet out that said, thank heavens this is happening in isolation. Nobody's actually talking about it. And they're not going to speak amongst themselves. It was the most sarcastic tweet I ever sent out. Mm-hmm. But all I'm saying is if one investor is in the process of liquidating their holdings and trying to be the first one out to get the highest price, they're certainly not the last. Mm-hmm. And that's in addition to your everyday mom and pop Airbnb jock who might or might not own 10, 15, 100 units and, got hit by Hurricane Beryl or Milton or Helene and is insufficiently insured. And now they're trying to get out from underneath a mortgage that they can no longer service for a home that's in need of repair that wasn't insured. Mm-hmm.
Well, we've been looking at, let's say, real estate in Florida, those, the amount of real estate that has come onto the market is just insanity. And I feel like that is just, again, another, beginning indicator of things to come.
And even so, Miami is still crane central. They've still got more supply being constructed, more than in really any other in terms of a percentage of the base of existing apartment condo stock in Miami, that city, metropolitan statistical area, it's got more under construction than any other in the country. So that situation is just going to continue to get worse before it gets better. You're going to have to, it's just the way things work. Supply goes up, prices come down. It's a process.
Danielle, everybody was worried about the commercial real estate bubble being a major risk to the banks and to the markets as well. It doesn't seem like this has really manifest the way that we thought it was going to. Why do you think that is?
Well, when you have a major credit rating agency like Moody's come out and say, we're looking at a serious issue here, that extend and pretend has gone on for so long that we're now seeing individual loans double default, meaning we will be downgrading these commercial mortgage-backed securities. Mm-hmm. And the regulators have really been pressuring the credit rating agencies to not downgrade these securities. Once you cross the Rubicon to double defaults, there's really no place to hide. And that's why we're seeing, according to TREP, the office delinquency rate crossed 10% in the month of November. These are some really high numbers. And again, the extend and pretend can only go on for so long once you start to see downgrades. And again, that's why we're seeing losses on properties that have been sold and changed hands upwards of 63%.
Mm-hmm. It seems like what you brought up earlier, this rising unemployment, falling house prices, rising credit card debt, delinquencies on mortgages. This is almost the perfect storm for banks to start taking losses. How do you think this starts to affect the banks? And could this be part of the catalyst of the credit crunch that you and I talked about before?
So when you see a bank come out with an announcement, a major Canadian bank come out with an announcement that says, we know that the write-offs and we know that the losses were larger than we anticipated, but we believe the situation is contained. When they start using words like that, you're like, whoops. So we are seeing banks take losses. We're seeing charge-offs increase at a very rapid rate, whether it's the auto loan portfolio or the credit card portfolio. And they're doing the same thing that we were just discussing in commercial real estate. They're modifying these loans. They're modifying auto loans. They're extending terms. They're giving households and consumers a break so that they can try and get them back on track. That can only go on for so long. You can only hide the sausage for so long. I hate to use such a crude term, but banks right now are trying really hard to slow the charge-offs, but they can only modify loans for so long if they're going to see a redefault. And we're coming to that season where people extend themselves as far as they possibly can in November and December, and then boom, they miss the payments come January, February.
Mm-hmm. Danielle, we've talked about the markets, we've talked about housing, all of these things. Is everything seemingly on a precarious tipping point here, or are there still assets worth holding?
Well, there's certainly still assets worth holding. There's certainly companies out there that have not cut their dividends and will not be cutting their dividends. And therefore, you can possibly take your lump in terms of what happens to the stock price, but still be assured that you're going to be generating income from that holding in your portfolio. The same thing could be said of some very well-run states and municipalities in the United States, where those municipal bonds are going to continue to pay regardless of whether the U.S. economy or how it weathers this recession. So there are certainly going to be places to hide, defensive moves that can be made to ensure that regardless of what happens with price, you continue to generate income. And I think that that's where investors should be focused, is weathering the storm.
Mm-hmm. Yeah, I think that's a perfect way to put it, is weathering the storm at this point is what we need to be focused on.
Well, look, your student loans haven't been paid since March of 2020. You're not penalized for that non-payment until January of 2025. But then you're going to have a whole new swath of U.S. consumers who have impaired borrowing and who don't have access to credit the way that they have since they've been able to stop making those payments in March of 2020. There are a lot of things, to your point, coming to a head at once.
Mm-hmm. Well, and again, to lump on as well the spending over the holidays, that extend and pretend season, as you just put it, to have student loan payments come back in January of 25. That's just another nail in the coffin, right?
It is. And, we've also seen the average U.S. household who plans to use buy now, pay later in order to float holiday spending. If they're planning to use buy now, pay later, which does not factor into your credit, mm-hmm. as the U.S. house does not report it to the Experians and the TransUnions of the world at all. It's like off balance sheet financing for U.S. households. But to the extent that U.S. households are planning to tap buy now, pay later, they're planning to spend $1,900 over the holidays compared to your average U.S. credit card buyer who's only planning to spend $1,600. They're like, oh, look, it's free money. But that's the attitude. That's the attitude that we have. That works. It works just fine until it doesn't work. And remember, these buy now, pay later lenders, they too have to secure financing from the big banks. So it all kind of comes together.
To that point, Danielle, I booked a flight this morning. It was a cheap flight. It was only $125. And there was an actual option to make payments on it. And I sat back and thought to myself, how many people, how many households use that option, and like how often does that credit facility get used on a purchase of, let's say, less than $500?
We know that a third of buy now, pay later users are using it to buy groceries.
Oh man. Well, as you say, this extend and pretend season has to come to an end at some point, right?
It does, but again, at the risk of sounding like a broken record, we might have been talking about commercial real estate being a train wreck a year ago, but these losses that are being realized are being realized. So, that's not a figment of anybody's imagination. And since we discussed commercial real estate, call it a year ago, untapped commercial real estate lines of credit have just about run out. So there's not much for companies to use in order for new construction loans or what have you. That money's been run through in the year 2024. I've got the data to prove it from bank earnings.
Danielle, as we wrap up here today, is there anything that you want to leave our listeners to consider or to think about?
So, my only message as we are in the spirit of the holidays is to, if Donald J. Trump is going to, if his second term is going to be more adult in nature, let's just use that term. And if he's really serious about cutting waste in government spending, that's going to amplify and exacerbate and make any recession feel worse. So my message would be, give this new administration a chance, because sometimes we have to take our lumps in order to get to a better place in the longer term, and cutting waste will get the United States on a stronger fiscal ground. And I think we have to be mature going into 2025 about, what those sacrifices might feel like. But in the end, it's going to be better.
Well said, Danielle. Of course, for those that want to read more of your stuff or to keep on top of all of these things, that's all available at DiMartinoBooth.substack.com, excellent Substack, as well as QIresearch.com, excellent Twitter follow as well, at DiMartino.
Yep, and we're actually extending our 20% off our new annual subscribers through the end of the year. So, you can read The Feather every trading day of the year for 20% off. I cannot believe I just made a sales pitch. I'm going to get struck by lightning. Anyways, but I would love to have you come on as readers. We crank out 4 great charts every single day, and I think some of those unique analysis and research that's out there.
Excellent. Danielle, thanks so much for your time today. Really appreciate it.
Thank you. Happy holidays.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.